Hi, my name is Dominic Tamaro, and I'm Vice Chair for Education at the Warren Alpert Medical School at Brown University in Providence, Rhode Island. This is one of our modules for the financial literacy curriculum, which we've built here at Brown, and today's theme will be on life insurance.
Hi, my name is Lisa Gavin. I am Vice President of Finance at the American College of Physicians and Secretary of the ACP Insurance Trust Program.
Hi, I'm Kim Kowalski-Ortiz. I'm the Vice President of Account Development for AGIA Affinity. We are the brokerage and provider of the ACP insurance.
So Lisa, why don't we dive into it? The people that are going to be listening and watching this are, for the most part, in their 20s, maybe early 30s, but they're early on in their career. Death is not something that they're thinking about foremost in their minds. Why should someone at this stage in their career think about life insurance?
Especially for early career physicians, a lot of them have student loans. There may be people that co-sign those loans. If you're getting into your early 30s, maybe there are people that depend on you financially or reaping what comes from the investment you've made in your education, becoming a doctor. So really, if you have student loans, you have anyone that relies on you financially now or think they will in the future, if you answered yes to any of those, life insurance is definitely something you should look into.
So you make the case that life insurance is important, especially if people rely on us for income and lifestyle and all that. Is there a benefit to that consideration early on? You know, when people are not likely to die, what is the advantage of thinking about life insurance earlier rather than later?
There absolutely is, and I'll let Kim go into the specifics, but the earlier you can lock in a policy while you're younger and healthier, the cheaper that policy will be. And a lot of those policies can stay with you for longer terms, and you can lock in a rate at a lower time. You really need to look. You'll probably have some life insurance through your employer or the program you're in right now with residency. That's not portable. You're probably in a position right now where you'll be changing jobs in the near future and other stuff, and any employer-based life insurance will not follow you wherever you go. So having a supplemental policy that's portable is very important, especially when you're at a stage where you may be moving around and making decisions about your career, but also the benefit of time of locking something in when you're younger and it's cheaper that you can carry with you is very important.
If I have no one that relies on me for my income, single, I rent, I have no student loan debt, is that person less of a candidate for life insurance than someone with all those other dependents on their income?
It's definitely situational, so you need to look at what you need, and maybe if you have minimal debt, an employer policy could cover what your needs are. But I think a lot of people get confused, you said no student loans, or maybe they think, oh, well, my student loans will just be discharged. Federal loans likely could be discharged, but you may have private loans. You may have loans that were co-signed, by a parent or a relative that don't automatically go away with your death. So you really have to look at your specific situations, and there may be areas that you think are not a problem if you're no longer here that absolutely are. So it's still definitely worth considering.
Okay. And is it true that if no one relies on my income right now, but perhaps in 10 years they will, and having a policy already, you said the earlier I get it, the more likely it'll be less expensive, might be advisable?
When you go to take any type of insurance policy, underwriting is done. Just like when you took your auto policy, they looked at your history. So with life insurance, you're younger, you're healthier. When you're in your 20s, it's going to be much more affordable. So maybe you don't have anything now, but maybe you're dating someone and in the next 2 years you're going to want to marry her. If you get that life insurance policy now, you're paying a rate that you could lock in for as you get older, before you hit any health scares, that would then cover you. It's not a have to, but we always do recommend life insurance. and you said it in the opening of all of these different modules, it's a way to decant. It's a way to offset the risk. You know, you want $100,000, $200,000 policy. A 20-year-old may only be paying $15, $18. I think that they view insurance as very expensive. Did some research, and there is a non-for-profit, it's called LIMRA. So they estimated the cost of life insurance and, you know, how individuals 18 to 30, what they think it costs, and they overestimated it by about 10 to 12 times the amount. So it's interesting that, oh, I don't need it, I don't want it, you know, understandable, but if you aren't paying, you know, 10 to 12 times for it, and it'll stay with you, does it become worth it? So on the next slide, when I looked at cost, so this is not us, this is not any of the companies we work with. It's a quote for a $250,000 policy for 20 years. So this will give the viewers, you know, a good overview of what the cost actually is. So for a 30-year-old, the average male can get it for $18 a month. The average female, it's $15 a month. As they move into their 40s, maybe it's $28 a month for a male, $23 a month for a female. As they move into their 50s, it could be $67 a month if you're male, $51 a month if you're female. So think about that. As we go back to that young person who doesn't need it or doesn't have any debt, if he had purchased it in his 30s, he could still be paying $18 now that he's in his 50s versus paying $67 a month. So the idea is it's a cost savings over a period of time for them, but yet a $250,000 policy, that may cover the mortgage for that woman he wants to marry, you know, for the house they have in the future. And I think a lot of people just look at insurance as being very expensive. It's affordable. It's really a matter of what's the amount of the policy you need, you know, what's your health look like? Again, younger, less expensive, but what are your needs? And what is it within there that you want to cover?
And so that when you talk about the needs, are you talking about existing needs or future needs? So for example, you know, I might want to have kids and save for their education. If I die prematurely, I'm not going to be able to do that. Is life insurance something that can be used to cover that?
That's actually what it is for. It is for your future, right? So once you have that policy and say you were that 18-year-old male paying 18, if he had the type of a policy that could be locked in for 10 years, then he's paying that lower amount as he buys a house, you know, as he gets married, has a house, has a family, has cars. It's there to cover for your future. So if you know what your potential is gonna be, then you should get a policy early on. I will say a lot of doctors, as their income goes up, they'll even purchase policies up to $1 million to $2 million, because really that is the income they have. So then as they have that family and that house, if something were to happen to them, what is the time frame, depending on their age, that, you know, maybe they have really young kids, 2-year-olds, 3-year-olds. So they have to think about the future, and this policy has to cover into the future. So why not think of it early on as to what your future is going to be?
You had mentioned the term underwriting. Maybe you could define that. And then my question is there any way to avoid underwriting?
So there's no way to avoid underwriting. Underwriting is what the carriers do. They take a look at your medical health, and that's what, when you look at rates and everything, that's what it puts you into categories, and that's how they know how much to pay. It's a mathematical process that I won't even try to get into because I am not as smart as an actuary, but it is the longevity and the likelihood and what they'll need, but it is part of the process to make sure that they're eligible and how much they're eligible for.
Lisa, what's ACP's role in the life insurance picture?
The American College of Physicians was a membership association. Many years ago, ACP created the ACP Insurance Trust, which is a holder of a group life insurance policy. It was designed by doctors, members of the ACP, for doctors. So this is a member-only benefit. If you are a member of ACP, you have access to a group life insurance policy through the ACP Insurance Trust. What's great about that is we're able to provide a discount, for lack of a better word, on your rate that you'd pay for that. So actually the ACP Insurance Trust will contribute generally 20% of the premium for that rate. We also offer membership discounts for people that are enrolled in policies. So it's a very important benefit to our members. I think anyone that's looking for life insurance should, shop around. You'll have an employer policy, very likely. They may offer a supplemental policy. If you're a member of ACP, you certainly should look at the ACP Insurance Trust, or maybe you're a member of another association that has similar type benefits. So as you're looking at it, look around, but anything that you can get in a group policy is going to come with greater discounts than you would get just going on the market on your own and trying to find a policy.
I think we've established that life insurance is important, that it is probably more affordable than people may have thought, and that it covers a fair amount of risk that we may or may not be aware that we're all facing. Having established that reality, how do I start? And I know that there's a lot of different types of life insurance out there. What should people be looking at?
So your employer benefits will probably offer you life insurance. They do tend to cap it. So maybe it's 1 to 2 times your salary, or maybe they cap it at $300. So you should look at that first and say, okay, good, I'm covered here. If your mortgage is $300, if you don't have dependents, okay, maybe you feel that's enough for you. However, if you have extra bills, if you have a mortgage that is much more than $300, let's say $500, $600. Life insurance, you really should look at your overall income, and you should be doing about 6 times your income. That's what I recommend to people. Because what you're trying to do is you're trying to protect your family or your loved ones, whoever needs it. So if I'm capped at $300, I'm definitely gonna want an additional policy, one that I can get at a high face amount, maybe $1 million, maybe whatever it is. And then looking at that, if I get it at a younger age, then I know I'll be paying a lot less for it. So it's good coverage to make sure, you don't leave your family in a situation of debt.
And also consider where you are in your career. Are you just established with a hospital program and you're going to stay there forever? Or are you planning to either go into private practice or switch careers? Portability is very important. It's great that employers offer life insurance, but the minute you no longer work there, that policy's done. So a supplemental policy can essentially bridge the gap. You can take that no matter what you're doing in your career, or if you take a break from your career or anything else, you have that with you along the way. So that's definitely something to consider.
So you had mentioned the prices, the estimates that you had mentioned before, having done some research, is for term insurance. Can you define what that is? And
sure.
Is that the type of life insurance that a rookie getting life insurance should consider first off?
So you have your level term life insurance. Level term is typically 10-year, 20-year, 30-year. It is a locked-in rate that stays the same over the life of the policy. So the one I was showing before, the $250 for 20 years, means that $18 is what that person will pay every month for the next 20 years. That's why we say locked-in rate. But there are other types of insurance as well. There is an annual renewable term. It's a 1-year policy, so maybe you're not sure, or you go in thinking, all right, let me try this. The good thing about it is that once you've gone through the underwriting, once you're approved for it, it'll just automatically renew. You don't have to go back and get another medical or any of those pieces done or answer more questions. The only thing about an annual renewable is you saw the different rates, like at 40 it jumped, and then at 50 it really jumped. If you're on an annual renewable, and you stay in that policy, those rates will change at certain intervals as you get older. So you will end up paying more, and maybe that's fine for you, or if it's not, you want to lock in at the lower rate, the level term is really good for that.
I know that there are also life insurance policies that are combined with investments and savings that seem maybe beyond the scope of our discussion here, but maybe you want to touch about that so
Sure.
people will be aware of them?
You're talking about a whole life policy or a universal whole life policy. So those are great. Those actually add a cash value, meaning here's your face value and what you've put in. So if the insurance company, they're also an investment firm, if they've invested and maybe it made a little more, then instead of just the 100,000 at the end of the term, you might have a little bit extra. But the thing about those policies is they do come at a cost, because they're going to be a higher dollar amount to you on a monthly basis because of that investment factor. And they usually have an expiration, so depending, you'd have to read the policy, but maybe it ends at age 70 and then that face value is yours. So if you can afford it, I definitely say look into it. But when we're talking about your students, your residents, your early career physician, that's where, and I've heard this from carriers, 80% of the people cover themselves with term life. And the reason they do is because it is much more affordable. So if you can afford the whole life, universal life is really dependent on the market, and you have to go to a specialized agent for that, one who would have a Series 6. If you can afford those type of policies, yes. But if you've got all that debt we talked about, right? You've got this huge loan because you started out as a doctor, you've got multiple loans, but now you have to pay rent or you're paying a mortgage. Something more affordable, like a level term, is better. And the other thing to think about is they're never locked in, meaning if you go and you check a quote, Lisa's very big on telling people, go check a quote, look at different things. I know with ACP, there is a 30-day free look, meaning if you started to pay for the policy before the end of the 30 days, you could say, I really don't want this. They'll give you your premium back. It's after that it kicks in and it keeps going. But I think if people do that, they'll see, oh, geez, it is only 15, it is only 18. It's not a lot of money and I can make my bills work. And I think they would stay with the policy. Also, at any time, if you're paying your premium, the carriers have to cover you, right? The policy is written that they will cover for a death. Suicide is usually an exclusion, meaning no suicide in the first 2 years. So the one at risk is the carrier. They're gonna pay that face value. But if anytime you're like, I'm done with this, I paid off my house, I'm good, you can stop paying your premiums or you can cancel the insurance. It's up to you. If you wanna keep it, if you need to defer that risk, or if you don't.
The person dies, their survivors get a check, and is it that simple?
It's not that it's not simple. When the person dies, you do have to have proof, so you're gonna make a claim, but all of the carriers are really good about that. So you call a claims agent, and they will assist you with the documentation that's needed to be provided, and then there is typically not a long waiting period as they go through everything, they cover everything off, and then they will pay out the face value of the policy.
I think that covers all of our major themes for life insurance. It certainly is clearer to me, and I suspect for a lot of the folks that are watching. Is there anything else we should talk about?
When you're looking at life insurance, you should look at the benefits of the policy. So, we talked about term, like how long do you want it for? Maybe you are the 40-year-old and you only want 20 years. That will also change the rate. So if you do a little less time, it's gonna be less expensive. If you do a little more time. We talked about this even when we did another series on disability. People should also look at any waiting period, any time frame within the policy. What does that do as well? And then they should also look to see, as Lisa said, are there additional benefits in the policy? So some life insurance policies, if you get a terminal illness, they'll actually pay out before you've passed in order to help you with coverage. So look at the different benefits in a life insurance policy. So when you're going to do, like Lisa says, look at the different quotes, you've got to look at the different benefits within the life insurance policy and as to what those offerings are, because that's also something I think people don't pay attention to. And if you have those extra added benefits, that's just part of it. And if it's the same rate, why not get the one that has the extra benefits part of it? So I think that's something people don't always look at.
Well, I think that covers a great deal of information. It certainly demystifies some of the characteristics of life insurance, and it's really helpful to know about the policies and support from the ACP. So thank you very much.
Thank you for having us.